What is a credit report? Well, I'm so glad you asked. So by the end of this video, you're going to have a great understanding of what credit reports are and why they're a crucial part of qualifying for a home loan. Welcome back. My name is Gavin Sessions with Loans Made Simple. If you're curious to learn about all things related to mortgage and home loans, subscribe to our channel. We post new content each week. If you're ready to get qualified for a home loan or looking to get connected to a great real estate agent, scroll down. Our contact information is in the description below. All right, so as I mentioned, this video will provide you an educational overview of credit reports and how they're related to a mortgage transaction. And we're going to do that by reviewing 4 topics. Number 1, we're going to define what a credit report is. Number 2, we're going to explain why credit reports are necessary when qualifying for a home loan. Number 3, we're going to debunk some of the fears surrounding credit reports. And number 4, we're going to provide you a few pro tips for maintaining a healthy credit report. All right, so let's jump into it. So what exactly is a credit report? Well, think of your credit report as your financial report card. It's a comprehensive document that outlines your credit history, summarizing how you've managed your credit accounts, paid your bills, and handled your debts over time. All right, so your credit report is compiled by 3 credit bureaus, and you've probably heard of them: Experian, TransUnion, and Equifax. And your credit report plays a crucial role in various financial decisions, especially when it comes to qualifying for a home loan. So we don't have time to discuss every data point that's included on your credit report, but these are the main things worth noting. So first, you're going to see your name, your social security number, your date of birth. You're going to see a list of your recent credit inquiries. You're going to see 3 credit scores, one from each of those bureaus we talked about, from Experian, TransUnion, and Equifax. You're going to see a list of all open and closed accounts, and each of those accounts is going to include a date that the account was opened, a last reported date, the credit limit on that account, the account type and the balance of that account, the minimum monthly payment on that account, and the number of months remaining on that account. So the most common types of accounts that you're going to see on your credit report are credit cards, auto loans, student loans, and mortgages. And if you're currently renting a home, we typically are not going to see that type of thing on your credit report, nor will we see utility bills or cell phone bills. All right, so let's take just a minute to discuss credit scores, which can range from non-existent, in other words, 0, all the way up to 850 plus. All right, so generally speaking, higher credit scores typically mean lower account balances and a clean payment history. It also usually means that your accounts have existed for a longer period of time. So on the flip side, lower credit scores typically mean higher account balances, which is also known as utilization, late or missed payments, a shorter account history, and possibly collections or charge-offs. So credit scores, as I mentioned, come from all 3 bureaus, and all 3 of those scores are typically fairly close to each other. And to be approved for a mortgage, we're typically looking for a minimum middle credit score of at least 620. So that means we're going to ignore the highest and the lowest credit scores. So if your credit scores are currently lower than 620, there are a few programs that will accept lower credit scores, but it's typically best to get connected with a credit repair expert. And we've got great people on our team that can help with that. So by and large, higher credit scores mean favorable loan terms and a much higher likelihood of your loan being approved. All right, let's move on and address the big question: why is your credit report such an important part of the home loan qualification process? So to answer that question, we're going to focus on 2 reasons. The first is when you apply for a home loan, lenders are going to use your credit report to assess your credit worthiness. They're trying to determine if you're a responsible borrower and whether you can be trusted to repay the loan. So a positive credit history often translates to favorable loan terms and lower interest rates, whereas a negative credit history can lead to less favorable terms, higher interest rates, and even having your loan denied. All right, so here's the second reason, and we already discussed that your credit report includes a comprehensive list of your debts or liabilities and their corresponding minimum monthly payments. And that data is used to calculate your debt-to-income ratio, which is commonly known as the DTI. And the important thing to take away is to know that your debt-to-income ratio plays a major factor in determining your purchasing power. Just want to pause the video for a quick moment and invite you to connect with us. If you're ready to take the next step to get qualified and speak to a mortgage professional, a loan officer, or if you'd like to get connected to a great real estate agent, click the links below. All right, let's get moving to section 3 here, which is debunking common fears about credit reports. So if you're a bit squeamish when you hear the word credit report, know that you are not alone. It's super common for folks to have fears or misconceptions about credit reports. So let's debunk a few of them. So the first one might be the fear of checking your own credit report. So contrary to popular belief, checking your own credit report does not harm your credit score. In fact, it's actually a really smart move to monitor your financial health regularly, and many financial experts recommend that you check your own credit report at least once per year. So a best practice might be to set a reminder in your calendar or your phone to do this each January, and below is a link to a website to check your credit report. All right, guys, so another common fear is the idea that a low credit score marks the end of the road for you. So while a low credit score definitely presents some challenges, I want to challenge you to believe that it's not the end, but rather just the starting point. So being informed is a great first step toward becoming empowered and taking further steps to improve your credit. So if you find yourself with lower credit scores, likely due to derogatory items on your credit report, such as late payments or missing payments, collections, please know that you do have some recourse. So as mentioned earlier, it's best to have a conversation with a credit repair expert. And if you'd like to get connected to that team, click the link below in the description or leave us a comment. Please also note that lenders consider multiple factors when deciding whether to approve a loan or not, and there are often many opportunities to improve your credit scores over time. All right, now that we've cleared up some of the misconceptions, let's wrap up with a few tips to maintain a healthy credit report. So the first tip I would say might seem very obvious, but it's really simple. Pay your bills on time. Payment history is a huge driver on your credit scores. I often tell folks that the credit bureaus are kind of like parents that come down really hard and they overreact to a first late or a first missed payment on their historically well-behaved child, right? So if your credit report has generally been clean and had no late payments in the past, the first time you do that, it's very likely you might see your credit score drop 100 points or more if that was to happen. Now, on the flip side, somebody that already has poor credit history, if they were to miss a payment or have a late payment, it likely has a much lesser impact than someone who has excellent credit and then misses a payment for the first time. Another quick tip is to keep your credit utilization low, and this means keeping your account balances, specifically on revolving accounts, less than 50% of the limit if possible. So simple math says if your limit on your credit card is $1,000, try to keep that balance at or below $500. So balances above 50% of the limit will hurt your scores, while balances at 50% of the limit should have a neutral effect, and balances that are 30% or below the limit should actually have a positive impact on your credit scores. Another quick tip is to be strategic about opening new credit accounts, meaning when you're in the checkout line, avoid applying for that credit card, even when the clerk says, hey, you can save 5% if you open a new account today. So keeping good habits like that will contribute to a positive credit history, and it'll make you a more attractive candidate for lenders. So now you ideally have a really good grasp of what credit reports are and why they're important to the mortgage process. So if you're watching this video, you're probably in the market to purchase a home. If you're ready to buy or refinance, scroll down, click the link in the description below to reach out to us. And I encourage you to go watch this video next to continue your education in the home buying process.